Dividend stocks are attractive to many investors because they provide you a source of revenue, passive revenue, where you don't have to do anything and you can just get this additional source of revenue income every single quarter, or in some cases monthly as well. And high yielding stocks are a step above that, where they provide very high yields to investors for holding the stock. And you really see this particularly with something called REITs, real estate investment trusts. So what I did was I tried to sift through all the REITs that I could find, pick out ones that actually seemed like pretty decent buys either right now or in the near future, and had pretty healthy charts and financials behind them. Oh, and of course, all of these provide at least a 10% yield. So it is a very high yield dividend video we're covering here today. Now, the last thing I want you guys to get sucked into is to find a REIT that pays out, say, like a 20% yield. But when you look at the business fundamentals, it's a very struggling business. They could go under very time soon. Maybe they can't sustain this payout. So what I want to do is actually show you how I look at REITs in these 3 picks here today. And you can kind of extrapolate that for other REITs that you may be interested in as well. Remember, any dividend paying stock does not have to continue paying out their dividend. Although REITs do have to pay out a portion of their dividend by law, that dividend yield is completely dependent on how the business does. So if the business goes bankrupt or struggles, that yield is going to struggle as well. And really, you just got to remember this, that just because a stock pays out a dividend today, it does not guarantee that it will continue paying out a dividend tomorrow. So do this with every dividend stock you have in your portfolio. Take a look, see how sustainable that dividend is, and if you do think that company will continue paying the dividend out in the next 5, 10, 15 years or more. Anyways, regardless, let's get into our juicy dividend picks here today. Coming in at number 1 is a company called New Residential Investment Corp, ticker symbol NRZ. So this is a company that was founded in 2011 and is based in New York, New York. And their focus is on investing in and actively managing investments primarily related to residential real estate in the United States. More specifically, the company invests in excess mortgage servicing rights, MSRs for short, on residential mortgage loans. And they also invest in servicer advances, including the basic fee component of the related MSRs. It also invests in real estate securities and residential mortgage loans, as well as in consumer loans, including unsecured and homeowner loans. So what kind of yield does NSR give us? Currently, we're sitting at almost a 12% return, which is extremely attractive, with a payout ratio of around 69%, which is acceptable and fairly sustainable in my opinion. And when you compare the stock's performance versus the index, the S&P 500, as outlined in their report here, you can see that it has actually well outperformed the index over the last few years. And even with this performance, analysts are still seeing a 10% upside from the current prices here of NRZ. And now if we jump over to their charts, we can see that it did correct like the general market did in December, but has since recovered and is doing well at this point, sitting above its 200 moving average. We seem to have found some sort of stability here in the stock, and even if we continue moving sideways, you gotta remember you're getting over a 12% yield on this stock just for holding it. So it's a very impressive pick, and let's see if our second pick here can top this. Coming in at number 2 is a company called MFA Financial, ticker symbol MFA. So similar to NRZ, they also own and manage a portfolio of residential mortgage-backed securities, or MSBs. They are primarily secured by pools of hybrid and adjustable rate mortgage loans on single-family residences. And in a recent letter to their shareholders, they said that in the last 10 years, their analyzed total stock return has been 14.5%. Pretty impressive, and it is above the typical 7% that the S&P yields. However, when we look at the comparison here of the S&P and this stock over the last 5 years, we can see that it actually performed fairly poorly, with a 7% loss over this time period versus the S&P's almost 55% gain. But of course, we're investing solely here for dividends. We're not really looking at capital appreciation, so that shouldn't be of too much concern for you if you plan to hold this for the long term, just to get that dividend income into your account without really doing any extra work. So MFA actually pays out a 10.78% yield, which more than makes up for the poor performance that the stock has been having, and then some. But my problem here is with their payout ratio, which currently sits at around 117%. Now, this is not really sustainable over the long term. This is definitely going to have some sort of repercussions. Maybe they're going to cut the dividends. Maybe the company is actually going to struggle. Don't really know exactly what's going to happen. But we do have to be cautious of this. And I would say at this time, because of this high payout ratio, I would just be watching this stock. I would not necessarily be buying into the stock like our first pick. But that being said, if they do make more money over the next year or so, that payout ratio will most likely drop and become a lot more sustainable. So we'll really have to wait and see what's going to happen with this company in terms of their payout ratio and if that dividend is sustainable. And kind of to add to the negativity, analysts are actually seeing some more downside here in the stock, about 5.66% lower from where it is sitting today. So things are not looking all that great from a capital appreciation standpoint, but you do get that dividend at least for now. Now, if we look at the charts here, you can see that it's a fairly volatile stock, jumping from $6 to $9 pretty frequently. And right now it's sitting kind of in the middle of that range. So it may come down to around $6 or so at some point again. So I'd kind of keep this on a close watch list here, watch the stock, see if it comes down to a more attractive price point, and then I would be more happy entering this position, especially if they can increase their earnings and reduce that payout ratio. Okay, now let's move on to our third pick here, which is Invesco Mortgage Capital, ticker symbol IVR. So what these guys do is actually a few things. So they do residential mortgage-backed securities for which a U.S. government agency or a federally chartered corporation guarantees payment of principal and interest. Second thing is residential mortgage-backed securities that are not issued or guaranteed by a government agency. Third is commercial mortgage-backed securities. And the fourth is residential and commercial mortgage loans. So unlike our other two picks, they're actually both in the residential and commercial space here. So it does give you a little bit more diversity when looking at their portfolio. And currently they pay out just over 11% yield here, which is right in the middle of our first and second pick. But what does concern me and why I have this as the third pick here is because they don't really publish their payout ratio, which as a potential shareholder does kind of raise a red flag here because I don't really know how sustainable this is. Maybe that payout ratio is somewhere in the 50s, maybe it's in the 150s. Don't really know, and it's not really something that I feel comfortable as an investor, which is why I'd consider this a pretty high risk play. And kind of to add to the negativity here, you can see that analysts see more downside of around 12%, so capital appreciation may not be the best play here either. And when looking at how it's performed versus the S&P 500, they've done worse than the benchmark index by far. It did perform better than MFA, which is our second pick, but it still returned a loss on capital appreciation over the last 5 years to investors. And the charts show us here that it's a really slow mover in general, usually spending most of its time moving sideways. However, if you're able to catch it on a correction, like in December, then you will get a higher yield on cost and get some handsome capital appreciation gains as well. So personally, I would add this to my watch list, keep a close eye on this, see if things change with the business because that yield is attractive, but I do want to see more stability in that, including more transparency on the payout ratio. So guys, there you have it. As it stands today, I think, in my opinion, NRZ is the most sustainable pick. It's the safest pick in my opinion out of these three. And it also has a pretty good potential for capital appreciation as well. Remember, I want to stress this once again that just because these companies pay out a high yield today does not mean they're going to pay out a high yield tomorrow. So position yourself accordingly. I wouldn't personally put 100% of my portfolio into a REIT, but it doesn't really hurt to diversify yourself a little bit and expose yourself to a little bit of real estate here, even if it's in the form of stocks. Either way, guys, hope you enjoyed this video. Let me know if you want to see more dividend type videos on the channel. I always read the comment section, so leave a comment down below. Drop a huge like if you enjoyed this. Don't forget to invest positively, and I'll see you in the next one. Peace.